Now we take up our classes now to the next level, and I believe that you are okay with chapter 1 of financial accounting, where last time we did introduction to accounting. We covered areas to do with nature and purpose of accounting, objectives of accounting, users of accounting information and their information needs, qualities of useful accounting information, accounting concepts, as well as accounting principles, accounting standards and their importance, and the accounting equation, or basically the basic accounting equation. That we've covered in chapter 1. If you missed that lesson, just get our chapter 1 from our YouTube. We have already uploaded that particular chapter in our YouTube channel, Fatima Institute. My name is Kimanzi of Fatima Training Institute, Center for CIFA Studies. My contacts are 0727 871093. Before we move now to chapter 2 of financial accounting, as you can see from this side, chapter 2 of financial accounting, we are going to deal with double entry bookkeeping and books of original entry. However, before we move now to chapter 2, allow me to give you some questions from chapter 1, and maybe you can answer those questions. Now, the first question I have provided answers, so I'll read this one, then I present that to your camera or before your camera, and they can be of use to you as a student as you prepare for your examination. Now, explain the following concepts used in the preparation of financial statements. I'm saying before we take up chapter 2 of financial accounting, I'll give you some questions from chapter 1. We've already covered chapter 1. So before we move to chapter 2, get these questions from chapter 1. Explain the following concepts used in the preparation of financial statements. 1. Relevance. 2. Reliability. 3. Faithful representation. 4. Neutrality. 5. Completeness. And 6. Comparability. Now, that one I have answered for you. You can have the answers for that. You have the answers for that. These are questions from chapter 1, which you have already done. Now, I've answered that one for you. This is the meaning for relevance, the meaning for reliability, meaning for faithful representation, meaning for neutrality, completeness, and comparability. I believe you have that. You have that with you. You have that with you. You have that with you. Well, so you have that. Relevance, the meaning is there. Reliability, the meaning is there. Just pause your video and you read those notes, answers. Faithful representation, neutrality, completeness, and comparability. Now, other questions are there. Briefly explain the accounting equation. Next, explain 5 different uses of the financial statements of a business entity, citing what each party would be interested in and why. Okay, we have that. I move now to the next page. Questions continue on the other page. We are told there are questions there. Explain 4 qualities that good accounting information should possess in order to be useful to the users. Next, explain the term accounting policy. Next, explain the following accounting concepts. 1. Faithful representation. 2. Comparability. 3. Relevance. Next, citing suitable examples, explain the meaning of the following terms. 1. Accounting concepts. 2. Accounting basis. Next, summarize 4 objectives of accounting. Next, describe 3 external uses of accounting information, including the information needs for each user. Next, discuss 4 limitations of financial accounting information. Next, explain the following accounting concepts. 1. Going concern. 2. Consistency. 3. Prudence. 4. Accrual. Next, enumerate 4 objectives of financial accounting. Next, discuss 4 qualities of useful accounting information. Next, explain 4 limitations of financial accounting. Next, explain the following terms as used in accounting. 1. Accrual basis accounting. 2. Substance over form. 3. Cost principle. Next, monetary unit assumption. Next, the objective of financial statements is to provide information about the changes in financial performance and financial position of an entity that is useful to a wide range of users in making economic decisions. Required list 5 users of financial information, clearly explaining their information needs. Those questions are from past papers of past Kenya Accountants and Secretaries National Examination Board. Now we moved out to chapter 2, and that is double entry bookkeeping and books of original entry, including manual and computerized systems. So we are supposed to take source documents, books of original entry, the double entry system and the ledger, the trial balance and basic financial statements, computerized accounting systems, role of computers, application and accounting software in the accounting process, benefits and challenges of operating computerized accounting system, and that will be the end of chapter 2. So you can have what we're expecting from that particular chapter. So we are looking at chapter 2 of financial accounting. We'll be looking at source documents, books of original entry, the double entry system and the ledger, the trial balance and basic financial statements, computerized accounting systems, role of computers, application and accounting softwares in the accounting process, benefits and challenges of operating computerized accounting systems. So chapter 2, that is what you expect. That is what you expect from chapter 2. So source documents in accounting, usually we have a lot of information. We discussed about accounts or accounting, what accounting entails. And we say that accounting is more about information system, collecting information, analyzing information, that is collecting information, recording information, analyzing this information, and presenting this information to the intended users so that these users may make decisions based on the information presented. Now, this information definitely has to be recorded somewhere for the first time. This can either be invoice, delivery notes, cash books, receipts, quotation, purchase order, or any other. So this will be some of the source documents that we will be discussing in this class. Source documents where we first record these transactions. If you make a sale to a customer, that sale has to be recorded somewhere for the first time. That is the starting point of these transactions, where you post these transactions once they occur for the first time. So sales, you record in the sales book. Purchases, you are recording in the purchases book if they are on credit. Then out of these documents now, you can collect information out of these documents. Then the process of accounting continues from there until you prepare the financial statements. Well, let's go straight away now to the source documents as we discuss them each one at a time. What source document is, in every business, it is usual to record every business transaction in a document. And such documents include, I will start with these source documents here. My number one will be invoice. My first source document is invoice. We invoice a customer if the sales are on credit. Whenever you see an invoice, it is telling you that we have sold goods to a customer and this customer has not paid. So you are telling the customer, this is what you owe us. You have our money. See that if you sell goods and the customer pays, what you issue is a cash receipt showing that the customer has paid, so there is no debt. But if the customer purchases goods or services and this customer is to pay later, then you issue an invoice telling the customer you have purchased goods from our enterprise and you have not paid, so you are obliged to pay us in the future. So invoice is just one of the source documents where we record transactions involving sales which are on credit, sales which have not been paid for, sales which are yet to be paid for. I read the meaning here, but you have a point. The most important thing is knowing what invoice is. Invoices, this relates to the sales order or the purchases order, where goods are sold on credit. So underline that. That's the most important thing there. Where goods are sold on credit. Where goods are sold on credit, the seller must issue an invoice to the buyer showing the quantity supplied and the amount that he is supposed to pay. So the invoice, one of the contents of invoice is the quantity sold, the unit selling price, and the total amount that this customer is supposed to pay in the future. So where goods are sold on credit, the seller must issue an invoice to the buyer showing the quantity supplied and the amount that he is supposed to pay. The details of the invoice must match the details of the sales order. Invoice is a request for the customer to pay what he owes. So, invoice is a request which is being made by the seller to the buyer, telling him or her what he or she is supposed to pay. When a business buys goods on credit, it will receive an invoice from the supplier. The invoice contains the following details. So these are the details of invoice. 1, name and address of the seller, date of sale, description of the goods sold, details of discounts, if any, total amount of the invoice, then quantity of goods sold, including the unit price. Then uses of invoice. Uses of invoice: 1, it is a request for payment. Number 2, it can be used in matching the eventual payment. Number 3, it can be used as a record of sales. And next, it can be used when the goods are being dispatched from the warehouse. So basically, that is what invoice is. Understand the contents of invoice as well as uses of invoice. So I present that portion to you. As we proceed, I present that one to you as we proceed. So we are taking source documents. You can look at invoice. You pause your video and you read about invoice. The details of invoice are here. Then uses of invoice. I've given 4 uses of invoice. These are uses of invoice, and these are contents. I move to sales order. The next source document is sales order. Number 2 is sales order. Sales order. You know what an order is. If you place an order, what are you telling the supplier? These are the goods that I'm requesting to be supplied with. Sales order is a request made by the buyer to the seller requesting for certain goods or services that the buyer wishes to be supplied with. So this is a document requesting for the goods or services that the customer wants to be supplied with. That's sales order. Is a source document because I've written somewhere. Now before I continue, I have an invoice here. I have an example here. I have an example here of an invoice from one of my customers. So maybe you can have this. Maybe because it is confidential document, allow me to hide some information. Allow me to, I will not show you all the information because this belongs to one of my clients. So for that reason, just allow me to hide some information. But that is that's an example of an invoice. That's an example of an invoice. That's an example of an invoice. So That's an example of an invoice. So we go to sales order, and you'll say a sales order is a document requesting for the goods or services for the customer that the customer wants to be supplied with. If I'm the customer and I want to be supplied with 100 units of a certain product, I'll write that one in my purchase order or sales order. Okay, next is credit notes. The next source document is credit note. Anytime you see credit note, what should come in your mind is overstatement. We sold goods to you, but we brought more than what you ordered for. You requested for 50 units of product A, but we have supplied 55. So there is extra 5 units. So that invoice has been overstated, either in terms of quantity or in terms of the amount, in terms of currency, either shillings or dollars. Overstatement of invoice. What is appearing in the invoice is more than what you had requested for. So in that case, we write to you a credit note. So in other words, we are telling you return the difference. So anytime you see a credit note, what we expect is return inwards on your side. We are telling you return the difference. On your side, you should be talking about return outwards, because you have to send back the difference back to us from your side. So credit note is that source document which is telling the party involved that there is an overstatement of the invoice. So whenever there is a credit note, there is overstatement, and for that reason, the difference has to be returned. So to the issuer of the credit note, he or she expects return inwards, and to the person who has been issued with the credit note, that person you expect return outwards. In that case, I believe you understand. So, but for the time being, okay, we'll be coming back to this as we continue with financial accounting. However, at this level, understand that credit note, the purpose of credit note is to correct that misstatement, which is overstatement. So, credit notes. This is a document sent by the seller to the buyer, showing that sales of the goods that had been sold to him were overstated. It can also be defined as a document sent by the supplier to the customer in respect of the goods returned or overpayments made by the customer. It is actually a negative invoice. It's a negative invoice. We are referring to it as a negative invoice because you have to return the difference. Because of that minus, you have to minus something out of the invoice. If your invoice is written 1.1 million shillings and there is an overstatement of 0.1, if your actual invoice was to be 1 million, but it is written 1.1, we are saying this is a negative invoice because the credit note issued, you are being told return the 0.1. So minus the 0.1. That's the reason why we say that a credit note is a negative invoice. A credit note is a negative invoice. It has to affect the invoice. It has to affect the invoice in the sense that you have to less the excess figure to correct your invoice. Next is debit note. Number 4 is debit note. Debit note is the opposite of credit note, whereas credit note corrects overstatement, debit note corrects understatement. So credit note corrects overstatement, debit note corrects understatement. So what are you being told? We are telling you that the goods that we supply to you are less. So what are we supposed to do? We earn the difference. We bring more. If you placed an order worth 1 million, but we brought goods worth 900,000, it implies that we have not supplied the 100,000. If you placed goods worth 1,000,000 shillings, but we have delivered 900,000, then it means there is, and we have supplied less. We have supplied less by 100. So we should issue you with a debit note showing that we should supply the difference. So I will write to you a debit note to correct the difference. I'll bring more. I'll bring the difference. So debit notes, this is a document sent by the seller to the buyer showing that sales have been understated. So the key point here is that credit note is for overstatement, overstatement, whereas debit note is for understatement. Those are the key points there. Where there is credit note, there is overstatement, and where there is debit note, there is understatement. We'll say that credit note is a negative invoice. You can as well take debit note as a positive invoice. Even though the first invoice was also positive, the debit note is a positive invoice because again, we are bringing the difference. So we have to plus the figure that we have in the original invoice. We have to plus the new figure that we are bringing in to correct the understatement. Okay, I think that is well captured. So basically, credit note corrects understatement, debit note corrects understatement, credit note corrects overstatement, and it is a negative invoice, whereas debit note corrects understatement and it is a positive invoice. Okay, next is receipt. Number 5 is receipt. Now that's obvious. Where you have invoice, we have said with the invoice you have sold goods on credit and you are telling the buyer that this is the amount that you are supposed to pay us. You have our money. You have our money. The invoice, the purpose of invoice is to tell the purchaser that he or she has our money and he or she has to pay us in the future. With the receipt, it means that the customer has paid. So there is no debt. Here, the customer has purchased goods and he or she has paid us and we have settled that particular transaction. No obligation to pay in the future. The transaction has been settled today. So receipts. So you see, for example, if you get into any supermarket and you purchase goods and you pay, you are usually issued with a receipt showing that you have paid and there is no future obligation on your side to pay. So what you receive is a receipt. You pay cash or you pay check or whichever method that you're using. And once you've paid, you are issued with a receipt as an acknowledgement that you have settled this particular transaction and you have no future obligations to pay. So, The opposite of receipt is invoice. You have seen that. Receipt. This is a written confirmation that money has been paid. A written confirmation. A written confirmation that money has been paid. So that is receipt. Is a source document. It's a source document. Next is quotation. Number 6 is quotation. 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 Quotation is a written offer to the customer to deliver goods or services for a certain amount of money. So you are telling this particular customer that I can supply these goods and services at this particular amount. I'm quoting my price. You get into my business, or you come into my business, and you are asking me if I was to purchase these particular goods from your business, how much will you charge me? So I'll quote my prices. I'll give you quotation. Usually, or most of the times, when the government or companies want to purchase certain goods, or they want to have services from different people, they have to compare the prices from different suppliers, because by the end of the day, we want to save as much as possible. So what we do is that we take prices from different prospective suppliers so that we may compare where can we get these particular goods and services at the lowest prices, so that as a business we save on our side. So what happens is that you have to obtain prices from different prospective suppliers so that you may compare these prices. So this has to be written in a quotation. That's what you mean by quotation. The quoted price. This is what I'm willing to charge. This is what I'm willing to charge if you purchase these particular goods and services from a business. So quotation is a written offer. You know what offer is. I believe you have done the law of contract. You have done the essential requirements of a valid contract. You have done things like offer, acceptance, consideration, capacity to contract. Okay, you've done offer, so you know what offer is. And if you have not done the law of contract, I will be taking you to the law of contract in a few days' time. So here, the term used here is offer, because in any contract there has to be an offer and acceptance. So this is my offer. I offer to sell these goods and services at this amount. That is what I'm offering. And then the other person now, that is a prospective purchaser, has to accept my offer or reject the offer, because there are only two options. Once I make an offer to you to sell these goods at a certain amount, then the prospective purchaser has to look at my offer. If he or she is comfortable with my offer, he or she can either accept my offer or reject my offer. So if he or she accepts my offer price, which is in the quotation, then it implies that I should supply that particular purchaser these particular goods and services at the quoted price, the price which I have quoted there. I cannot supply at any different price. I will supply at the quoted price. So this is the commitment that I'm making through the promise written in this document, that I should, if given that particular assignment, supply these goods and services at this certain price. So quotation. Next is purchase order. Number 7 is purchase order. Is the other source document. Purchase order. This is a request by a business to another business for the goods that it needs to be supplied with. Okay, that's simple. Next is goods received note. Number 8 is goods received. Goods received note. Now, once you place an order and these goods are delivered, you have to show that these particular goods have been received. So you should be showing the quantity received and the conditions for these goods when they were received. Were they in good order? Were there some which were damaged? Were they of the right quality? Were they of the right quantity? And others. So basically, goods received note. Once you receive the goods in your business, then you have to show, you have to issue goods received note. You have to compare what was in the quotation and what was maybe in the purchase order, and then is it really that which was ordered for that we have received. Okay, so goods received note. This is a list of goods that the customer has received from the supplier. The next is goods dispatched note. Number 9 is goods dispatched. Goods dispatched note. Now, whereas we are talking about goods received note, what we are receiving from the other side, the supplier who is supplying to us should have his or her own documents showing these are the goods which have left my premises. These are the goods which have left my business enterprise. When the customer now receives those goods, he has also a responsibility to issue goods received note. So the two businesses now should be able to reconcile or compare in case there are any discrepancies in terms of quality, in terms of quantity, or anything else, that these were the goods which we dispatched and these were the goods which were received. If the customer is raising issues, that is, I did not receive the right quality or the right quantity of the goods, then you should be able to communicate with the supplier so that the supplier may look at his or her goods dispatched note. Because some goods may be lost on the way, some goods may be stolen on the way. So if goods have been stolen or some goods are missing within the process of the transportation, then we should be able to raise the question of this is the amount of goods dispatched. Why is it different from the goods received? What happened in between the transportation process? So basically, we have goods dispatched note and we have goods received note. You should be able to see that. It's quite simple because the supplier, when goods are leaving the supplier's business, the supplier has to issue a statement showing this is the quantity of the goods that we have dispatched, this is the quantity, the quality, and the transporter has to sign that particular document showing that it is true that which is written here is the correct information. So that if there is a difference when the customer received the goods and is writing the goods receipt note, the same transporter should be answerable to the same because he or she is the one who signed the goods dispatched note. Okay, then we have the statement. The other is statement. Now, statement is another source document, and a statement is a document sent out by the supplier to the customer listing all invoices, credit notes, and the total payments made by the customer. So the statement now is showing maybe all the invoices and all the payments made, and by the end of that statement, we should be able to see the balance, the outstanding balance. Assume, for example, I have been supplying you with goods for 1 year. Now, by the end of the year, I should show you all the invoices that I've supplied to you and all the payments that you have made, so that you should be able to see the total supplies to you on credit, the total cash that you're paid, and the balance outstanding, what I owe you. So that's a statement. That is a statement. A document sent out by the supplier to the customer listing all invoices. Remember, invoices contains goods sold on credit. So payments and credit notes. Remember, credit notes means if there were overstatements and how they were corrected, and debit notes if there were understatements, and also the payments made, and then finally the outstanding figure. That's statement. Lastly, remittance and wise. We have remittance and wise. Remittance and wise is a document sent by the seller indicating the invoices which are being paid and the credit notes being offset. Okay, that is that about source documents. Source documents, we have invoice, sales order, credit note, debit note, receipts, quotation, purchase order, goods receipt note, goods dispatch note, statement, and remittance and wise. Okay, so you can just have that. I'll present that one to you. After that detailed explanation, we have source documents there. We have done invoice, sales order. The rest you have is credit notes, debit notes, receipts, quotation, purchases order, goods received note, goods dispatch note, statement, remittance, and wise. I'll move now to what you see here is books of original entry. Pause your video and take up books of original entry. Books of original entry is where we are moving to now. We are moving to books of original entry. Books of original entry is where we are moving to. Now, books of original entry. Books of original entry are also known as journals or day books. So we have books of original entry. Now these are also known as journals. Or day books. Day books. So books of original entry, also known as journals or day books. So basically, with the day book, anytime you come across day book, it means that those transactions were made on credit. Now, books of original entry are known as either journals or day books. You have said that journals or day books. However, in the case of the last book of original entry, now when I talk of the last book of original entry, I mean what I present to you here. The last book here, according to the arrangement that we have in the book, is a general journal. So they say in the case, however, in the case of the last book of original entry shown below, this is a general journal. Okay, it is always a journal, and the second last is always known as the cash book. Okay, the way they appear in here in the notes. What I present to you. The term daybook is perhaps more commonly used as it more clearly indicates the nature of these books of original entry. Entries are made to them every day. The commonly used books of original entry are, so the day books, we are calling this day books because we record these transactions there on a daily basis. So the commonly used books of original entry are: one, sales day book. The first one is number one. Number one is sales. We have sales day, sales day book, sales day book, or just sales journal. And this is for credit sales. This is for credit. This is for credit sales. So we have sales day book, sales day book. So we are saying this sales day book is for credit sales. Anytime you make sales on credit, you write that transaction on the sales day book. So anytime you come across sales day book, realize that these transactions recorded there are on credit. And you also remember the invoice on the other side. If there are sales and these sales are on credit, they have to be appearing on the sales day book, and then you transfer that. In other words, that figure should, you see, the sales day book. The business owner is the one who is having this sales day book, and once you write an invoice, you issue the customer with the invoice. You remain with the copy. The customer goes with the invoice, but you don't issue the customer with sales day book. You are the one who is keeping the sales day book. That is all the transactions relating to credit sales in your business on daily basis. So you are showing what is happening in your business on daily basis. So the invoice you issue to the customer showing the credit sales, but you maintain the sales day book records. Number two is purchases day book. We have purchases day book. You can guess the alternative name or what is it for. These are credit purchases. Credit purchases. We have credit purchases. You find it in the purchases day book. You are doing a lot of purchases every day. Some of these purchases are on credit, others are on cash basis. So anytime you purchase goods on credit, you record them in the purchases day book, so that by the end of the day, you should be able to analyze all the purchases which were made on that particular day on credit. You should as well be able to look at all the credit sales that you made on that particular day. You have the totals for each particular day. So purchases day book or purchases journal. Remember, this is also called sales journal. Sales journal. You know the alternative names. Sales day book is also called sales journal, where you record credit sales. Purchases day book, where you record credit sales, is also known as purchases journal. Purchases journal for credit purchases. Next is return inwards. Return inwards daybook. Return. We know what return inwards are. The sales which were made, but the purchaser has returned them back to us. Those are returned inwards. So you should have a list of those sales which have been returned back to us by the customer. So return inwards daybook, also known as sales returns. Sales returns daybook. Sales returns. Sales returns daybook. Sales returns daybook, also known as return inwards journal or return inwards journal. What we record there is return inwards daybook. So in the return inwards daybook, we are recording all the sales which were made to the customers, but they have been returned to us. Next is return outwards daybook. We have return outwards daybook. Return outwards daybook, also known as purchases returns daybook, also known as purchases returns daybook. So we purchase now from the customers or from the suppliers. Is the purchases returns is the opposite of sales returns. We are the ones who have purchased these goods and then we return them to the supplier. So return outwards daybook or purchases returns daybook, also known as return outwards journal. Remember the alternative name, return outwards journal. What we record is return outwards. So here we record return outwards. See the difference between return inwards and return outwards. Return inwards means the sales that we made to customers and they have returned to us. So return inwards are to do with customers or the goods that we had sold and the customers have returned to us. Return outwards means we had purchased these goods and we are sending them back to the supplier. So you record that one in that particular book. Next is cash book. Number 5 is cash book. Now, cash book is very important because we'll be required to present cash books, either 2-column cash book or 3-column cash book. So the cash book, what you record there is the actual cash received and the actual payments made. Actual receipts, actual payments. We don't record credit transactions in the cash book. If you purchase goods on credit, there is no money out. So that particular transaction, which does not entail actual cash movement, cannot appear in the cash book. If you make sales on credit, you can only write invoice. You record that transaction in your sales daybook and you issue the customer with an invoice showing that no cash has been received. But on that particular day, when the customer pays, that is when you will record that transaction in the cash book. So note that in the cash book, we only record actual cash received or actual cash paid. And in the cash book, we can either have cash or checks, because there are those customers who are paying by cash, there are those customers who are paying by cash or by check. As well, you can be making payments now by cash or by check. So in the cash book, as you come to the preparation of the cash books, you realize that on the debit side of the cash book, you have the cash column and the bank column, and also on the credit side of the cash book, you'll be having the cash column and the bank column. So cash book basically records actual movement of money. Actual movement of money. There is no credit uh, transaction which should appear in the cash book. If cash has not been paid, if cash has not been received, then it cannot appear in the cash book. We are only interested with when we pay or when we receive, when money comes in or when money moves out. So that is important point to note when dealing with cash books. So cash book is for receipts and payments of cash and checks. So actual movement, the cash book, you are interested with actual movement, not anticipated movements, actual movements, when you pay or when you receive. If you have not received, don't record that transaction in the cash book. If you have not paid, don't record that transaction in the cash book. It helps you to know the cash balances that you have as at a particular date. Next is petty cash. Next is petty cash. Now, what is petty? If you tell somebody you are petty, it means petty means mediocrity. Mediocrity from the grammatical perspective. So petty, as you use it in accounting, we mean those amounts which are very small. Those amounts which are very small. The last lesson in chapter 1, we did something, one of the accounting principles and concepts known as materiality. Last lesson, we discussed about materiality. And we said a transaction is said to be material if its omission or misstatement can affect the decision making if that information has been used either in the absence or in the absence of a certain misstatement or omission. If you refer to that particular lesson that we did last time in chapter 1 about accounting concepts and principles, we define materiality that way. That a transaction is said to be material. A transaction is said to be material, or a misstatement is said to be material, or information is said to be material. A figure or an amount is said to be material if its omission or misstatement can affect the final decision made by the user of that information. If the user is making decision in the absence of that, in the, either the absence or the presence of that particular omission or misstatement. So you can refer to that the previous lessons. Now here, the petty cash book or petty cash, what you record in the petty cash, what you are recording in the petty cash or the petty cash is those figures which are too small. You'll be discussing about the preparation of the petty cash book and the impressed system. So you are dealing with very small amounts. For example, if you spend 10 shillings, 10 shillings to purchase a bio like this one. If a company has spent 10 shillings to purchase a biro like this one. That's a petty figure. So you need a record where you need this petty cash book where you are recording very minor figures, figures which are too small to an extent that they cannot affect the business operations in a much extent. So petty cash. Then lastly, we have general journal or general journal. So lastly, we have general journal. The general journal or journal if the term daybook is used for the other books of original entry. And here you write other items. So here you write all other items. Record other items. So books of original entry, you have that. I present that one to you. I will present that one to you. And we have books of original entry. We have sales daybook, purchases daybook, returns inwards daybook, returns outwards daybook, cash book, petty cash, and the general journal. You can pause your video and you take up that. Pause your video and you take up those notes. Important. Okay, we move away from that and discuss something else. An important point here. Okay, there's a point here. Let me present that one to you. I'll present that certain point. You have it here. You can read that the books of original entry are also called the books of prime entry. Entries are made in the books of original entry. The entries are then summarized, and the summary information is entered using double entry to accounts kept in the various ledgers of the business. One reason why a set of ledgers is used rather than just one big ledger is that this makes it easier to divide the work of recording all the entries between different bookkeepers. The different types of ledgers most businesses use are sales ledger, and this is for customers' personal accounts. Purchases ledger, this is for suppliers' personal accounts. General ledger, this contains the remaining double entry accounts such as those relating to expenses, fixed assets, and capital. Now, can you have, should have that analysis there. Just have that table there where you have all business transactions. You have that table. It helps you understand more. You have all business transactions. Then after that, classify or put same types of transactions together. So they can either be credit sales, credit purchases, return inwards, return outwards, cash receipts and payments, then other types. Under the credit sales, what you have is you enter in sales daybook. So all the credit sales should be entered in sales daybook. Credit purchases, you enter in purchases daybook. Return inwards, enter in return inwards daybook. Then return outwards, enter in return outwards daybook. Cash receipts and payments, enter in cash book. Other types, enter in journal. Then enter in double entry accounts in the various ledgers like sales ledger, purchases ledger, and general ledger. You see, in the sales ledger, you have both credit sales and cash sales. Purchases ledger, you'll be having both credit purchases and cash purchases. So that table is important to you. It is helping you to understand what we have done right now. You can pause your video and you go through it. Just pause your video and you go through it. Okay. This point, okay, maybe you can just continue with that point there, whereby you have said some people describe all accounts as personal accounts or as impersonal accounts. We discussed that last time, types of accounts. So you have personal accounts, impersonal accounts, real accounts, and nominal accounts. Now that we did last time, chapter 1, types of accounts. We also have journals used there, sales daybook, we have done that, purchases daybook, return invoice daybook, return invoice daybook. Now this should be, now rectify this, this should be return outwards daybook. So this one is return outwards daybook, not return inwards. This for recording return outwards. So point of correction here, return outwards. Then the books of original entry, we have them there. Sales daybook, purchases daybook, sales returns daybook, purchases returns daybook, cash book, petty cash. Okay, I think we are okay. We are okay with that. Now we move ahead. We move ahead. Now we are through with this portion. We are through that portion. We move on and we go to double entry system. Double entry. Double entry system. Double entry bookkeeping. Chapter 1, we talked about the dual aspect principle. That is, each accounting transaction should have twofold, debit and credit. You debit one account, you credit the other account. That's double entry. Take for example, if you purchase a motor vehicle and you pay by cash, you should have an account for motor vehicle account, you have a delivery, and you have another account for cash or just cash book. If you have a delivery, now note this, as we mentioned and as we will discuss in a while, that all assets have a debit balance. Increase in assets we debit, decrease in assets we credit. All liabilities have credit balance. Increase in liabilities we credit, decrease in liabilities we debit. All expenses have debit balance. Increase in expenses we debit, decrease in expenses we credit. All incomes have credit balance. Increase in incomes we credit, decrease in incomes we debit. Okay, so if we are saying we are explaining the concept of double entry, remember that this side is debit and this side is known as credit. This is debit and this is credit. Just a simple explanation. This side, when we purchase a motor vehicle, it means money out. So when you say all assets have a debit balance, it means that the opening balance is always on this side. balance brought forward. The balance coming from the previous period, opening balance, and the balance carried down is on that side. So whenever we say that all assets have a debit balance, it means that the balance brought forward or the opening balance is on the left hand side. If the balance brought forward is on the debit side, obviously the balance carried down should be on the opposite side. So remember that it is this balance carried down which becomes the balance brought forward next time. If we close this account and our balance carried down is on this side, when you open the accounts for next period, this balance carried down will be on the debit side. The same applies here. So our balance brought forward is on that side, and balance carried down will be on that. So we are saying that all assets have debit balance, meaning that the balance brought forward is on the left hand side. Increase in assets we plus. Increase in assets we debit. When assets increase, we write that transaction on the left hand side. Decrease in assets we credit. When assets decrease, we credit. We write that transaction on the right hand side. The same cash is an asset, so increase in assets we debit, decrease in assets we credit. So we are saying that the double entry system, because in accounting we are interested with increase in a particular transaction, and when a transaction increases, there has to be corresponding amount decreasing. If one side is decreasing, the other side must increase by the same amount. And if there is a difference, then we should be able to identify what has caused the discrepancy or the difference between the two. If you make sales worth 1,000, then you should indicate the stock decreasing by the same value and cash increasing by the same value. If you make sales of stock, assume this is what I'm selling. If this is my stock and this item is worth 1,000 shillings, if I sell this item, my stock should decrease by 1,000, which is equivalent to 1 unit. Now that my stock has reduced by 1 unit, my cash should increase by the same figure. So decrease in stock should indicate increase in cash. And if this item was sold on credit, then my cash is not increasing, but my debtors should increase. So there has to be another ledger indicating the difference in terms of why this item in my stock has decreased. Why is it decreasing? So if my stock has decreased, I have to show a corresponding ledger showing an increase as either the cash is increasing or the bank figure if it was paid by check. And if it is not appearing in the cash book, then it has to be data. Somebody has purchased on credit. So either a cash book is increasing or debtors are increasing. And if that is not the case, then there is either maybe my item has been stolen or it has been lost, and therefore I have to ask myself, why has my stock decreased and there is no corresponding ledger showing increase? So double entry means, so we mentioned that in chapter 1 about dual aspect concept, that is in recording transactions or all the accounting transactions must be twofold. We talked about twofold. Transactions in accounts should be twofold. That is, you debit one, you credit the other. And the figures should be the same. The movement should be the same. Okay, so we are assuming that we are purchasing a motor vehicle. If I purchase motor vehicle and I pay by cash, then cash is reducing. So I'll record that figure here. I'll write motor vehicle and I write that figure there because you have said cash is reducing, money out. And then this same figure here, because money has reduced to purchase a motor vehicle, and motor vehicles are increasing, I should show that figure here. I'll write here cash or bank, and I'll bring that figure here. So the figure appearing on the debit side of the motor vehicle should be the same figure appearing on the credit side of the cash book. So what you're saying is that with a double entry system, when you credit an asset or you credit a ledger, you should debit the other ledger with the same figure, showing that this particular ledger has reduced by a certain figure so as to increase another ledger. That's what we mean by double entry system. Okay, we have done that. So understand that for the time being, when we come to calculations, we will be able to learn more. However, that's the meaning of double entry system. That is what we mean by double entry system. Okay, double entry system. What we are saying that the concept of the double entry entails that every account must have twofold. Twofold, you cannot have one ledger. There has to be two ledgers because accounts is about movement of transactions. If it has moved from here, it means that side has decreased. If it is moving from here, which other ledger is increasing? Because we are in the same business, money should not be moving out of the business without corresponding ledger, without showing where is this money going. So if one side is increasing, we have to show where is this amount coming from to make this ledger increase. If this ledger is decreasing, we have to show why is it decreasing and where is this amount which is making this ledger to decrease going. Where is it going? So accounts is about movement and tracking this movement. These resources are moved from here and this side has decreased. So where is it going? You have to show which ledger, where is it going? It can just move from here and we can't show where that amount is going. So you have to show where is it going. If it is increasing, you have to show where is it coming from. So this double entry helps businesses or business enterprises to show or to track the origin and destination of transactions. So double entry bookkeeping helps us to understand the origin of transactions and the destination of the transactions. So that if we see there is a movement of certain resources and we cannot identify where these resources went, then we should be able to see there is either fraud or there is an error. If you are not able to track the destination of the movement of resources of an enterprise, we should be able to clearly know that there is either an error or there is a fraud. And that is where auditors come in. That is where auditors come in to establish the whether the information which is contained in these books reflects true and fair view position of the business enterprise. So the concept of the double entry entails that every account must have twofold. The left hand side is known as the debit side. So the left hand side is known as so we have uh, we have an account this way. So this is debit side and this is credit side. I can just assume this is my asset account. Now we said assets have debit balance, so you expect balance brought forward to be on this side, and you expect balance carried down to be on that side. If it is an asset, increase will be on this side and decrease on that side. I used an example of asset account, and we said all assets have debit balance, meaning opening balance is on this side and closing balance is on this side. Increase in assets we debit. So when assets increase, you'll be recording those figures there. When assets decrease, you'll be recording those transactions there. I assume my asset ledger. So we are saying that the concept of the double entry entails that every account must have twofold. The left hand side is known as the debit side. So this is the left hand side. This side is known as this side. This side is known as debit side, while the right hand side is known as the credit side. So this side, the left hand side is known as the credit side. You'll be using CR. So anytime you see CR, we mean credit. Anytime you see DR, we mean debit side. So the left hand side is known as the debit side, while the right hand side is known as the credit side. All assets are recorded on the debit side of the account. Any increase in assets must be debited in the account, while any decrease in the assets must be credited in the account. So this is how you record the assets. Any asset, we define what assets are when we are doing introduction. Now for liabilities, if you are to do the liabilities, then it is the opposite. If it is liabilities is the opposite. Liabilities is the opposite. It means for liabilities, balance brought forward will be on this side. Balance for liabilities and balance carried down will be on that side. So increase in liabilities with plus, and these are liabilities. Liabilities. So we say that all assets have debit balance. Increase in assets with debit, decrease in assets with credit. All liabilities have credit balance. Increase in liabilities with credit, decrease in liabilities with debit. Okay, that's important. So all liabilities are credited on the account. Any increase in liabilities must be credited in the account, while any decrease in liabilities must be debited in the account. Capital. Now capital is the same. The treatment for capital is the same as that of liabilities. So we have capital. So capital as credit balance. Increase in capital you credit, decrease in capital we debit. For capital, it's like that. Okay, then we have expenses. Expenses have the same treatment with assets. All expenses are debited in the expense account, e.g., water bills, electricity, etc. Any increase in expenses must be debited in the account, while any decrease in expenses must be credited in the account. Now, incomes. Incomes have the same treatment with capital and liability. So, all incomes have credit balance. Increase in incomes with credit, decrease in incomes with debit. So, all incomes such as discount received and rent are credited in the account. Any increase in income must be credited in the account, while any decrease in income must be debited in the account. When we say that all assets and expenses have a debit balance, we mean that the balance brought forward is on the debit side. When the balance brought forward is on the debit side, the balance carried forward will be on the credit side. When we say that all liabilities, capital, and income have a credit balance, we mean that the balance brought forward is on the credit side. The balance carried forward will be on the debit side. Balance brought forward is also called balance brought down. It is a balance coming from the previous period. The balance as per the current period is called the balance carried down. The balance carried down becomes the balance brought forward for the next period. Now, to analyze that important point there is that so note this point here. Assets and expenses. And then I have liabilities, capital, and incomes. Now remember that in the balance sheet, also known as statement of financial position, we have three items. In the balance sheet, also known as the statement of financial position, there are three items. 1, assets. 2, liabilities. And 3, capital. In the income statement, which is called profit and loss account, we have expenses and incomes. Now, as far as double entry concept is concerned, or the ledgers as we'll be looking at later on, we are saying that assets and expenses have the same treatment when it comes to double entry. See what I've written here. Assets and expenses have the same treatment when it comes to ledgers. So we mean that all assets have a debit balance. Increase in assets we debit, decrease in assets we credit. All expenses have debit balance. Increase in expenses we debit, decrease in expenses we credit. You can see assets and expenses. They have the same treatment, meaning they have what we mean is they take up these this is balance brought forward and balance carried down. So this side is plus minus. So these are assets and expenses. They have the same treatment. Expenses and assets should have the same treatment. That is, they have both assets and expenses have debit balance, meaning the balance brought forward for assets and expenses should be on the debit side, and the balance carried down should be on the credit side. When they increase, you debit that figure. When they decrease, you credit that figure. So that is what we mean by saying that expenses and assets have the same treatment. Now the other liabilities, capital, and incomes should have the same treatment. That means all liabilities have credit balance. Increase in liabilities we credit, decrease in liabilities we debit. Capital has credit balance. Increase in capital you credit, decrease in capital you debit. Incomes have credit balance. Increase in income we credit, decrease in income we debit. So we mean that they take this form. Balance brought forward. Balance brought forward should be on the credit side, and balance carried down on the debit side. So when liabilities, capital, and income, you're saying liabilities, capital, and incomes should have credit balance, meaning the balance brought forward should be on the credit side. The balance carried forward, that's the closing balance, should be on the debit side. When they increase, you credit. When they decrease, you debit. So basically, that is what you mean. So you note that, so that when we come to the computations, you will be conversant with those points. I should present that one to you. I should present that portion to you before we move to something else. Before we move to something else. So that portion is about double entry. If you're writing, you pause your video and you write about double entry system and the ledger. Double entry system and the ledger. Pause your video and you read this portion of the textbook. Then you continue on the other side. Just pause your video and you read up to where you have ledgers. Pause your video and you read up to where you have those ledgers. Okay. We can just move now to ledgers now. I move to ledgers. Move to ledgers. Now, a ledger is a record containing all accounts by the business. Therefore, the entire group of accounts maintained by a company is called a ledger. The ledger keeps in one place all the information about changes in specific account balances. Companies may use various kinds of ledgers, but every company has a general ledger. General ledger contains all assets, liabilities, and equity accounts. In other words, it contains all items that appear in the financial statements. The general ledger must be arranged in the following order. Beginning with the balance sheet accounts, that is the statement of financial position account, start with all the assets, followed by liabilities, then revenue and expenses. So you are arranging these items starting with the assets, then liabilities, and then equity. Those are balance sheet items or statement of financial position items. Then the income statement items, you have start with the revenue and expenses. Now what we are saying is that I just have this portion here about ledgers. Let's have this portion. You read about what ledgers are and take what ledgers are. You read from ledgers, and then you have the above information can be summarized as follows. You can see, you have said that assets have what? Debit balance. When assets increase, you debit. When they decrease, you credit. Expenses have debit balance. Increase in expenses, you debit. Decrease in expenses, you credit. Liabilities have credit balance. Increase in liabilities, you credit. Decrease in liabilities, you debit. Capital has credit balance, increase in capital you credit, decrease in capital you debit. Income has credit balance, increase in income you credit, decrease in income you debit. You've just explained this portion here. Now I want us to take an example. Let's take an example here. You can go through that example there. You are told the following information relates to Chaka Distributors, a partnership business based in Nyeri County in the month of June 2015. June 1st, bought fixtures on credit from Kilonzo for shillings 20,000. 4th June, the partners took goods worth shillings 10,000 for personal use. 10th, Ruto, who was a debtor, for shillings 50,000 was declared bankrupt and the debt was written off. Date 15. Some of the fixtures bought on 1st June worth shillings 1,000 were found unsuitable and were returned to Kilonzo. 18. Purchased office equipment on credit from Kimbo Limited at shillings 67,000. 25th. Sold some of the old kitchen equipment for shillings 30,000 on credit to Wangari. 28th. They brought in personal furniture of shillings 195,000 for business use. 30th, they received a bank loan from Equity Bank amounting to shillings 1.5 million by check. Required, prepare general journal to record the above transactions. Pause your video and you go through that question. Now our solution will be something like that. Just look at the solution there. Go through that question as I show you. As we discuss that, we have date, we have particulars, we have now we can illustrate that. Question we are told now, date 1, 1st June. So we have 1st June, bought fixtures on credit from Kilonzo. Now here, when you buy on credit, it means your fixtures are increasing. Both fixtures, your fixtures are increasing. Assets are increasing, so you debit fixtures account and you credit Kilonzo because Kilonzo is a creditor. So here we have said you go to fixtures, you write here fixtures are increasing, then you have Kilonzo's account, fixtures account. So when you purchase fixtures on credit, fixtures are increasing. You have said fixtures are assets. We said when assets increase, we debit. So that's why we are writing here 20,000. We go to Kilonzo's account, the same figure, 20,000, and we have closed that. Sometimes you can give narration of what is happening. Narration explains what has happened here. You'll be coming back to narrations later on, but you can just explain down here what you have done here. So if I was to give a narration, I will say to record purchase of fixtures from Kilonzo on credit. So I have recorded that. So number one, you will be date one, you will be told bought fixtures on credit from Kilonzo for shillings 20,000. In other words, it's like having a T account, two T accounts, and on the debit side you write 20,000, then on the credit side of Kilonzo you write 20,000. So remember, fixtures is an asset. When assets increase, we debit. Kilonzo is a creditor is a liability. When creditors or when liabilities increase, we credit. Date 4. The partners took goods worth shillings 10,000 for personal use. Now these are drawings. So date 4. Date 4. Date 4, what we have is drawings. We have drawings. We have drawings account, and then we have stock, the stock account. When we take these goods, definitely the stock is reducing. The stock is reducing, and we have said stock is an asset. Decrease in stock or decrease in assets, we credit. So our stock reduced by 10,000. 10 drawings. In drawings are like expenses. Drawings are like expenses. When drawings increase, we debit because drawings are like expenses. So you have recorded that. Date 4. The partners took goods worth shillings 10,000 for personal use. So these goods were coming from the stock. So stock is reducing. Date number 10. Ruto, who was a debtor for shillings 50,000, was declared bankrupt and the debt was written off. Now, this is date 10. Date 10. Now we'll be looking at something known as bad debts written off. When you write off a debt, bad debts written off are expenses because this is money that we cannot recover in the future. Now, this Ruto was a debtor. So when you write off a debt, that debtor reduces because that figure is no longer in your books of accounts. So debtor initially was an asset. A debtor is an asset. So when we write off that debtor, it means those debts have reduced. So we'll be crediting Ruto's account and we debit bad debts written off because bad debts written off is an expense which is increasing. So we have bad debts, we have bad debts account, and then we have debtors account. We have debtors account. So bad debts written off is an expense. We have said when expenses increase, we debit. So bad debts, we have 50,000. We debit bad debts. Bad debts is an expense, the same figure. Debtors, that particular debtor has reduced. We have written off. We don't want that figure in our books of accounts. So debtors we have credited. Then date 15. We move on to date 15. We move on to date 15. 15. We are told that some of the fixtures bought on 1st June worth shillings 1,000 were found unsuitable and were returned to Kilonzo. We had Kilonzo here. We had purchased these fixtures from Kilonzo on 1st June. So we return them to Kilonzo, and that is what constitutes return outwards. Return outwards have credit balance, and when you return these fixtures, it means fixtures are reducing. Fixtures are assets, and when they reduce, it means we have to credit. Remember, when you purchase these fixtures, we debited. Now that we are returning some fixtures to Kilonzo, we are just reversing this particular transaction. So we'll be writing fixtures account. We have fixtures account and Kilonzo's account. So we are basically reversing this particular transaction. It's the opposite. We purchase these fixtures. When we purchase these fixtures, they increased. So fixtures, when we return, we will be crediting, and the figure was 1,000. Fixtures, what we have returned is 1,000. We are crediting fixtures and we are debiting Kilonzo's account. We are reversing that. So remember, Kilonzo was a creditor. That was a liability. We had purchased from Kilonzo on credit. So the time we purchased from Kilonzo, we credited. Now that we have returned 1,000 to Kilonzo, we are minusing. We are saying we minus that figure from Kilonzo's account. That's date 15. We move to date 18. Date 18. We go to date 18 and we are told that purchased office equipment on credit from Kibo Limited. So office equipment is an asset. When we purchase this asset, it means assets are increasing. So we are debiting office equipment and we are purchasing on credit, and that is a liability, and that is Kibo Limited. So we have office equipment here. We have office equipment account, and then we have Kibo Limited. So when you purchase office equipment is an asset. So assets have increased, we debit that. And how much was that? Is 67,000. So we have 67,000 and we credit Kimpo Limited account with 67,000. So we are crediting Kimpo Limited with 67,000. We are debiting office equipment with 67,000. The fact that assets have debit balance and liabilities have credit balance, when we purchase this office equipment, they have to appear here. The figures should be the same. You can see from here 20, 20, 10, 10, 50, 50, 1,000, 67. They have to be the same because you have to stick to the double entry concept. So you go to date 25. 25th, we are told date 25th, sold some of the old kitchen equipment for shillings 30,000 on credit. So this is kitchen equipment have been sold and we are selling to Wangari. So Wangari becomes a debtor. So we have Wangari's account here. Wangari account. And what we are selling is kitchen equipment. You have kitchen equipment account. So Wangari, we sold this particular kitchen equipment to Wangari. So Wangari becomes a debtor. Debtor is an asset. So we debit Wangari's account with 30,000. 30,000. Kitchen equipment. When we sell this equipment, it means that that asset has reduced. The kitchen equipment has reduced because you have sold it to Wangari. But Wangari becomes a debtor. She has our money. We got to date 28. 28 is the other transaction whereby you are told that they brought in personal furniture of shillings 195,000 for business use. So when we introduce additional items in the business, that means capital goes up. So we are bringing in personal function. So function is an asset. So function is increasing and the capital is increasing as well. Function is an asset, and you're saying when assets increase we debit, when capital increases we credit. So we're having function here. So we have brought function, you have function account, and then we have capital. We have capital. So when you bring in function has increased by 195 and capital has increased by the same figure, because we are told that they brought in personal function of shillings. They brought in personal function of shillings 195,000 for business use. Lastly, we go to the that here. You go to the 30th, and we are told that they received a bank loan from Equity Bank amounting to shillings 1.5 million by check. So this is a loan. Loan is a liability. When liabilities increase, we credit, and we receive this one as cash. It was a cash. So cash is increasing. Basically, we are saying that the accounts we have is for loan account and cash or bank. Let me just use cash because when we got this loan, it came to our side in the cash book. We received that amount. And it's still write bank. In the book, you have written bank because it's check which is being issued. So when you get loan from the bank, loan is a liability. So our liabilities are increasing. So we credit the liability account loan by 1,500,000. So that loan is a liability. And cash now, we have received loan, which is in form of cash or the check which went through the bank, and our cash we are 1,500,000. You can still write bank to mean that the money has been received in form of a check. So that is it about that solution. I just present that one finally to you. Now, if you sum up these figures, you just have totals here. Your totals, if you sum up this side and that side, you should have the same figure. 1,873,000. 1,873,000 is the final figure. They should be the same because whatever is on this side is on this side, but on the opposite direction. Whatever is on the debit side is the same as what is on the credit side. So when you sum up that, those figures should be the same. So you can just have that example. Finally, you can go through that example. You can just go through that example. Finally, you analyze it during your free time. The example is there, and is containing date 1 up to date 30th. The transactions for that business are covering from date 1 up to date 30th, and you are required to prepare general journal to record the above transactions. The solution is there. The solution is there just as we have discussed. The solution is there. The solution is there as just as we have discussed. So just pause your video, you go through the question. Go through the question. Just go through the question, and you have that solution. So we have discussed that comprehensively. discuss that comprehensively. Maybe I'll give you example 2. You can go through example 2 and I'll present you the solution. Example 2, you can have that example 2. You have example 2. Pause your video and you go through that example 2. The solutions are there. Your purchases daybook, sales daybook. Go through that question. Here, this one this question you're explaining daybooks. I'll probably come back to that next lesson. They're having daybooks. We have daybooks. We have daybooks. And the last item was we have daybooks. That example we have. I've just shown that example. Example 2 was there, which I've given you as an. We have given that as your assignment. You have purchases daybook there. See how you have prepared purchases daybook, sales daybook for those particular dates there. Another purchases daybook there, sales daybook, purchases daybook, and we have that portion there. So next time, if you have a challenge, I'll do that for you. However, I prefer moving now to trial balance next lesson, so you can see how you have presented this information using the double entry concept. You're using the double entry concept. That is, in accounting, each and every transaction should have twofold. You debit one, you credit the other. And what is on the debit side should have a corresponding ledger recording the same transaction on the debit side. So this is what we mean by that. Remember here, you either have assets, liabilities, incomes and expenses, or capital. These are important notes to note here, that all assets have debit balance. Increase in assets you debit, decrease in assets you credit. That is why here with the fixtures, when we purchase these fixtures, they increased because we have brought these fixtures in our business. That is why fixtures, we have debited that figure because fixtures are increasing. We purchased from Kilonzo, who was a creditor. We purchased from this supplier to pay him later. So that's a creditor. That's why we say we credit Kilonzo's account, who is a creditor. A creditor is a liability. The other name for creditors or liabilities are payables. So it came from Kilonzo, and Kilonzo is a creditor. So creditors are liabilities, and liabilities have credit balance. Increase in liabilities we credit, decrease in liabilities we debit. So when we purchase from Kilonzo, that particular creditor increased. If you look at date 15, when we returned this fixture to Kilonzo at 1,000 shillings, some fixtures for 1,000 were returned. It means they reduced because they are going back to the supplier. It's like return outwards. So fixtures returned means fixtures reduced. You say decrease in fixtures, we credit. That's why we are crediting this particular figure there. And Kilonzo reduced. The Kilonzo's account reduced because when we returned to him, it means that his owing has 19,000 now because we have returned a fixture back to him, and the difference is what we are supposed to pay. We had to pay him 20,000. Now that a fixture of 1,000 has been returned, we only pay 19,000. So that liability has reduced from 20,000 to 19,000. That's the final implication of that transaction. So understand that concept that all assets have debit balance. Increase in assets, you debit. Decrease in assets, you credit. The same applies to expenses. The treatment for assets and expenses are the same. Liabilities, capital, and incomes have the same treatment. That is, all liabilities, all incomes, and the capital have credit balance. Their increase should be credited, their decrease should be debited. And when we say they have credit balance, it means that the balance brought forward is on the credit side, and the balance carried forward is on the debit side. That we have concluded. So that is enough for that. Next time we will move to trial balance. Next time we'll be moving to trial balance and cash books. So we come to the end of that particular discussion. So we are taking chapter 2 of financial accounting, and we are taking chapter 2 of financial accounting. So because of time, we stop at that. My numbers are 0727871093, or just plus 254 727871093. My name is Kimanzi Williams of Fatima Training Institute, Center for CIFA Studies. Remember to subscribe to our YouTube channel so that you may continue to get these classes as and we upload them. Because of time, we stop at that and we pick from there next time as we discuss trial balance and cash books. Thank you for viewing. We meet again.